everyone, and welcome to this webinar series, the SaaS Due Diligence series, co-hosted by Metrics Partners and Nauta Capital. So we are going to have 3 sessions, and each session will be about 1 hour long. We'll do some 30-40 minutes of discussion and just talking through the different parts of the due diligence of a company, of a startup, and we'll divide into before due diligence, during due diligence, and after due diligence. We'll explain a bit further about the topic later. But first of all, Xavier, hi, thanks for joining us.
Borja, hi, and thanks for having us.
That's a pleasure. So a bit about ourselves. So my name is Borja Breña, and I'm a principal at Nauta Capital. And we'll discuss about Nauta Capital later. But so I joined Nauta in 2018. I've been looking for incredible people to invest in for the last few years. And basically we invest and we back heroes. That's the quick summary of what we do. We look for world-class, capital-efficient, technology-based disruptors across Europe. We have offices in London, Berlin, and Barcelona, covering Western Europe. And we usually invest in B2B software at Series Seed or early Series A stages. So between 1 and 5 million, all the way from a company that has just recently launched their product, they have their first clients, all the way up to maybe like 200,000 euros MRR. And the good thing is, well, we're looking for companies that have capital efficient models to conquer the world. That's what we're looking for. Xavier, do you mind introducing yourself and Metrics Partners?
Thank you, Borja. Yes, absolutely. Metrics also has an interesting story. We are a boutique advisory firm. We are based here in Barcelona. We are focused in finance and strategy. This is our stronghold. In this slide, we have chosen to show you some of our sell-side SaaS clients. We also have buy-side clients, so we also work for investors. And we also have a biotech practice, which is not shown here because today is essentially about SaaS. So this is Metrics in a nutshell, Borja.
That is great. Excellent. So now that we're talking about, now we've already introduced ourselves. Do you think that we can just dive into the webinar proper? What we're going to talk about? What we're going to talk about in this webinar series? Do you mind just
yes.
Going through it?
Today we are running part 1 of a 3-part series that will be run in May, June, and July. So essentially in the spring quarter, and this will take us through real life examples of how top SaaS companies or top SaaS startups of different levels of maturity have managed their investment due diligence processes. Today, we are going to talk about the before. I think the leitmotif here is naturally going to be how to prepare for due diligence and how to find your place in the SaaS world when you are starting to fundraise. Session 2, which is on June the 9th, this will be focused on during due diligence. And here we are going to try to tell you everything about how to run the due diligence process. As you know, success in due diligence is driven by 2 things. First of all, the ability to negotiate, and second, the ability to run a robust process. Obviously, this is contingent on having done a good preparation, which is what we will cover today. So this is naturally today's session. Then finally, in July, or more already in summer, and looking forward to vacation, we will have our third, and our last chapter to discuss the after. The after is usually neglected, but it's very important. In the after, we are going to cover how is it about going back to business after a major investment, how to reshape your key stakeholders and the expectations and the processes you run with them. It's completely different. and the relationship that you will have with them. Obviously, this will drive you to a different next strategic phase of your company. So this is, in essence, how the 3 chapters are organized and the relationship between them. I think, Borja, it's interesting also if you can explain a bit why we prepared and why we set up this seminar, right?
Absolutely, we will explain why. Before explaining why, I would like to ask a question to the audience. Hopefully you will see poll popping up, like a window.
We can see that, yeah.
With a question, yes. So basically, this question we would like to understand from the audience. Have you ever gone through a due diligence? Have you ever experienced the joys of being subjected to a due diligence?
The pleasure of due diligence. Yeah.
So there are 3 options here, very simple. Yes from the startup side, yes from the investor side, or no, I'm new to this. Whilst we wait for the audience to vote, then I will explain why. And this is very, I think it's easy to understand once they explain it to you, but it's hard to understand if nobody has explained it to you. At least it happened to me. When you're a startup, you're company founder, you focused on your product, you focused on hiring, you focus on the action. Okay, you focus on the action of producing and selling. However, when you're doing fundraising, when you're looking for a round for some investors, you are not exactly focusing on your company. What you're doing is selling. You're selling part of your company, even if it's in a shares issue, and the investors are buying. So actually, in essence, this is a sales process. We'll discuss a bit further about that later. And I can make a bit of a comparison to selling a house. Selling a house would be like, the product would be, it has 3 rooms. This is the number of square meters. This is the first floor that has a lift. This will be the product. The selling or will be a bit about the location. Hey, this is the location. But this is not enough to sell the house, a flat. You need to have the house tidy. You need to have the pictures very nice, looking very nice, so actually people come to you. So basically you increase the chances, the probability of, number 1, selling the house, number 2, raising your price. So this is what we are doing here. Companies are obviously, the founders are very busy and they're doing lots of things, but when they forget to prepare for the due diligence, when they forget that they are actually being part of a dance, let's say, with the investor, with the buyer, they might actually lose value that they have created previously. So for me, I have been in the past seeing very good companies, very good founders that they were not ready to basically showcase, tell me the story that they're selling, to convince me to go in, or other investors I've seen, and actually to make me even pay higher. So this is what I think is very something we would like to help with. We would like to get the founders to extract the maximum value that they've created in the previous months running up to the round. And that's part of the reasons why we are doing this webinar series, to keep their house tidy so they look so nice that they sell quickly and at the highest price possible. Good. So we have some results from the audience, and actually I would say there is 1/3 each. So 1/3 of the audience has already come through a due diligence from the investor side, from the startup side, and 1/3 of them are new to this situation. So that's great to understand the audience, and now we can actually move into the first session properly.
Wonderful. Thank you, Borja. So hopefully those of you who have not yet done a due diligence and want to fundraise in the next months, quarters, and also people who already did it but found that they could have done better, will benefit from what we are going to discuss today, which is how to get ready for due diligence before it starts. Let's get cracking with this. Let's delve into this chapter so that you can meet your future investors' expectations. Some of you may know Holdet. Holdet is a company that is based in Barcelona, they managed to raise a very nice Series B recently, 15 million euros. It was a very competitive Series B with lots of interest that they could attract top VCs. And essentially, Holdet has a product which is an accounting and productivity tool for SMEs, where there is significant competition, so it's hard to stand in front of them. There's some very big firms there. And also, they have low average contract values, which prevent them from spending a lot of client acquisition. So it's not the super sexy, initially it doesn't look like the super sexy target for a Series B, right? Why did they manage to be so successful and to do it so well? Obviously, Holdet has a great team and has a great product. This goes without saying. But from having advised the deal by side, one of the things that I think was a key success factor, in my opinion, was also how well they prepared the ground for investors, well ahead of the round. And at the right moment, everything came in place, everything was ready, everything was a standard, everything was made sense, everything was cohesive. So these guys, they didn't have any secret sauce, but they played by the book and they did things right. And from stories like Holdet, we've tried to conceptualize a bit what we think is a winning strategy for a great company to prepare for a due diligence. We could obviously be talking for hours about this topic. Instead of just letting our imagination and our experience talk, we have decided to focus a bit to cover 4 main topics in detail that you see in this slide. We are sorry because we will have to leave many other important topics on the site, but please do ask them, that you have the opportunity to ask Q&As, and we will perhaps have the time to cover that at the end of our presentation. So today, we will essentially cover, first of all, the importance of charting your investment landscape, how to do this professionally. Second, the relevance of selecting the key metrics that will impact valuation, then to report the metrics well. And we'll explain the logic of all of these, and we will give you some real cases on how to do this well. Thirdly, something very important, which is even if you are very small, you need to go beyond, you need to transcend your run-of-the-mill accounting function, probably even something that someone does externally, where you have a lot of visibility, or maybe you're not even a specialist, or you're not a CFO. But for a SaaS round, you need to go beyond this, and you need to convert those ledgers and those balance sheets into top-notch SaaS management accounts that a professional investor will recognize and appreciate. And then our last topic today will be how to wrap your investment thesis around the business plan and how to make sure that the business plan delivers a consistent story and that the business plan can be pressure tested in different scenarios and under different what-if assumptions that people like Borja will prod you with. So you need to be ready for that. Having said this, let's talk about how to chart your investment landscape. This was very painfully evident a few weeks ago, and this is a real story. We got an email, came via a Gmail account, trying to sell an investment to us. And the good, or the sad story there is that it's a really, really good project that we are still trying to help. Obviously, this spray and pray tactic, where they are just contacting each and every living person on earth to see if they want to invest or not from a Gmail account, without even knowing if we were investors or what type of investors were we. So do we invest 10K or do we invest 10 million? So obviously, these guys are not going to be successful unless they change this a lot. Fundraising is essentially a sales process. Buy side and sell side, because I think, Borja, it's also a sales process for the VCs.
Absolutely, absolutely. So it's So people say, oh, actually, you guys, your VCs, you get all the opportunities, and it's not true. It is not true. And when I joined Nauta, I thought, oh, maybe Nauta is a recognized brand. It'll be easier to find great opportunities, and they will come to my door. That is not true. I mean, if you want to get the best opportunities out there, we need to, actually need to run a sales process, and we do have an outbound and inbound sales process with all the different parts, like SDRs, people closing, tracking. We have CRM. In our case, it's obviously it's a simple pipe drive, but we need the CRM. We track all the interactions with a company, and we also get out there to try and chase the best deals, like it happened with Hold It. So this is something that it's important for the founders to understand. That this is a process in which both parts are vying for attention of the best. In the case of the founders, best investors at the best price, and in the case of the investors, we're looking for the best founders. They usually have a number of investors trying to go in, so it's also up to us as investors to showcase our credentials and to convince them that they should accept our money, because we're going to help them in the journey, increase the probability of their success or lower the probability of failure of their company. And so we are also selling this ABC, always be closing, that's for sure. And this is what the Hold It people did. I mean, the Hold It guys, these are the heroes that we're usually looking for and trying to convince, to accept our money. So when we say we back heroes, we're looking for Hold It level type. But it's not that the product is amazing and the founders are really impressive individuals and the team itself is very powerful. Is that they also organize themselves in such a way that they achieve their best results. They get the best value for the best price for what they built. And I remember, as you said, Xavier, a few investors in different rounds after the ones that we went in. We went in a seed stage. The investors were telling them this is the best data room we've ever encountered at your level, at your Series A or Series B rounds. And actually the Hold It guys and many other portfolio companies of Nauta, and I'm sure of other VCs, you basically keep the investors warm with warm leads, like if you were selling an account, so you keep them warm, you keep them interested, engaged. So when you actually need them, they're ready to shoot. They already know you, and you get you get the best deal out of it. But Xavier, I think you should discuss the whole this old telephone style.
It looks like it's not a telephone dial. No, it's sort of a visualization in a 9-step process. And thank you, Borja, because this is a nice segue into presenting fundraising as a sales process, which we found to contain 9 relevant steps, right? Nothing new, just common sense used with rigor, okay? First of all, again, this is a parallel with the sales process. Start by doing a market research. So get yourself a TechCrunch account or a Crunchbase Pro account, or get to someone who does have that, and find out who's investing in your space. Find out how much are they investing, what are the theses they are looking for. It's B2B, it's B2C, are they leading, are they following? Do they always form part of a bigger syndicate? Do they want a specialized investor? All of this, you should sort of know your enemy before you approach them. Second, and you will see that again, this is pure sales tactics. Get yourself a CRM. Doesn't need to be Salesforce if you don't want to spend all that money. Can be Pipe-derived Trail or something which is cheap, but upload all the info into a CRM and everything has to be tracked up to the most significant detail, because memories are short and we are human beings. Process will be long. And typically you will talk in 9 months or in 6 months to a guy that you talked to first today, and you will completely forget the drill. And he will probably remind, because he will be running a professional project, And he will put you questions that you should have been preparing, or he will go through topics that he said next time we'll talk and we'll cover this, and you will not be ready. And there is a very clear way to preempt all of this. And I'm sure that if you are in sales, this is very obvious. If you're not in sales, it's not so obvious, which is tracking everything into sort of a CRM. Okay. Then, and this is sort of an epitomizes the story I told you about. Contact investors in a relevant way. If they don't do Series A, don't contact them about a Series A, because this will just burn your image. Try to relate your story to something that they did, because again, it helps a lot by showing that you did your homework and you are trying to be relevant to them. If you have a way to get in touch with those investors, which is more direct, like Borja is a colleague of yours and Borja can make an introduction to another VC, it's a lot better than Borja does the introduction than if you contact the VC cold door, or maybe even through the web page or something. So find the best way to contact people. Don't forget, this is human to human. So use this human. Number 4, process, right? Typically, you will start by thinking it will take less, but this will take at least 6 to 9 months, believe it or not. And more importantly, there are going to be different speeds of progress during the process. And this is dangerous because sometimes it will be too slow and sometimes it will be too fast. And both are bad. The answer to this is make everything a controlled process. So manage the timing well. If it goes too fast, be ready to go fast. Example, if someone says, look, I need you to change this and this in your business plan, it can't be delivered in a week. It has to be delivered in 48 hours. And vice versa, if you send your deck to a VC and the guy doesn't reply in 1 week, 2 weeks, 1 month, there has to be a process to make sure that this guy is kept in the game. And if you are interested in talking to this guy, it doesn't take until the end of the process, and this is bullet number 5, where you call the guy and say, well, by the way, it's great that you're interested, but now you have 1 week to do everything because I have a term sheet and I'm going to sign it next week. Then the guy will say, I'm sorry, but I know it's my fault, but this is not going to work. So your biggest chance of success, and this is in red because it's very important, is not only to get a lot of people interested, because this is not selling 5 units of one product. This is selling 1 unit to the highest bidder. So you need to get everyone running at the same speed and kept at the same pace. The way to do this is obviously if you see that someone is falling behind, again, human to human interaction, say, Borja, look, you are running. So there's folks that are already moving to due diligence and they are already looking at our data room and you have not even signed your NDA or whatever is the step before. So if you're interested, just wanted to let you know this is moving a bit faster than perhaps what you are doing. So he will know and he will catch up.
Absolutely. Just let me interrupt you, Xavier, but this is a good point. Look, this fundraising is not a beauty contest. So if you have 10 judges out there and they give you 9 of them give you a 0 and 1 of them gives you a 10, you've won. Okay. However, if all 10 give you a 7, but nobody gives you a 10, I mean, that's not what you want. You need somebody to trust you and go in, all in, give you a 10. So this is not a beauty contest. You don't need to please everybody. You need only 1 to give you the highest bid. And this is what we are trying to convey here. And what's one of the things that usually make people interested in something to make a move on something is that somebody else has done it or somebody else is about to do it. And this FOMO that human beings have, this is something that you should play with us. It's not that I'm going to follow and put a term sheet, a letter of intention or an offer only because somebody else has done it. Is that I'm going to be running faster You know, if I took generally, they say 3 to 4 weeks to decide to do the analysis, and somebody said we are already going into investment committee, we might get a term sheet in the next few days. I'm telling you, I'm going to run to get these 4 weeks into 2 or 3 weeks into 1. You know, so I'll run faster to try and make my decision just in time, just in case my decision is yes. Okay, so I'm not just following like sheep, but definitely it's going to make me, you know, hurry up. And basically the goal is to be able to have, you know, the choice of investors. You know, usually you know, let's be honest, most often companies raising funds, they get no offers, you know, and they need to go back home just thinking again, getting out there, maybe lower valuation, whatever. You know, if you're lucky, you can get one, and that's great. That's what you need. As I said, this is winning. Getting one good deal is winning. But the best thing to get, like the best deal possible, is to maybe have two term sheets on the table, even 3, which has happened to a number of the companies that I've tried to invest in, or companies that I am, you know, thankfully already inside. So when they have 2 or 3 term sheets on the table, I tell you, this is the best you know, moment. This is the 15 minutes of glory for a founder fundraising. So let's see the rest of the time.
Absolutely, absolutely. Sometimes you are not so lucky and you get a no, right? There's also value in that no. Obviously, a yes is best, but don't forget, and this is our 6th bullet here, always request and record feedback after a no, because this is not going to be a linear process. So eventually there's going to be iterations, reiterations, and there's going to be the possibility, if you do it well, to take many shots at the same story, spin it in different ways. So a no, which is well explained from someone who's knowledgeable and someone who's candid and someone who gives you good feedback, is almost like a yes, because you can get a second shot at the next one if you iterate well. So listen and record the feedback. And if they don't give you the feedback, request it. If it's not given, then it's usually a sign that they are not interested. Or sometimes they don't even understand what you are presenting, which sometimes happens. Don't forget also, and this is also a sales concept, it takes 2 no's for it to be a real no. This is not going to be a linear story at all. So at the end of the process, you can find people that you met at the beginning and they said no, and maybe they were not sure, they were just busy at the time, right? So again, this is human to human, and there's always the possibility to create a bit of FOMO, or, you know, go back and say, well, I just wanted to keep you updated on what's going on. This is what's happening. Remember that people typically do not like being sold at. So if you try to do a hard selling, they will not like that. But you say, look, I just wanted to keep you informed, and this is what's happening. So in the end, Nauta or whoever has decided to invest. So would you like? So guys typically have this FOMO and say, well, let's take a spin. They have time for that. It's their job. This brings us to the next point, which is communication. This is a moot point, but it has to be there. Need to have great communication, information flow that is impeccable and fast. So it can't be that someone requests something and it is done on purpose. If they detect that you're putting your data room together hastily, then that's an indication that you're not ready or not fundraising professional. Remember, one of the worst impressions you can give is someone who's part-time fundraising. That is something you don't want to happen. So have everything ready, make sure you follow up on everything, and make sure you keep everyone interested, because this is part of what we discussed in number 5, is we keep flowing in the process at the same, hopefully at the same rhythm. Or if they don't, it will not be your fault. It will be their fault. And you can always use it to say, look, guys, you didn't pay much attention. This is progressing. So now let's try to create a bit of FOMO and get you interested again. So all in all, bullet 9, which sort of wraps everything up, process, right? So this is, as you can see, a managed process. People that are in sales will recognize it easily. And what is important in all these processes is keep track of everything and know, be sensitive to how the next phase, how the phases flow and how to move from one phase into the other. Okay? So this is about charting your investment landscape. Sort of the second topic that we wanted to discuss today, not all metrics are equally relevant in determining your valuation. So this fact has been researched statistically many times. Here we talk about study by SAS Capital, but you will find many others. You can read those papers, and all these papers conclude that SaaS valuations are 70 to 80% driven by three metrics that are covered in this slide: growth, net retention revenue, or churn, and the acquisition inefficiency. If you look at, for instance, Nauta's investment thesis says they are only going to invest if you're efficient in your acquisition. Okay, so just a few words about each of these metrics, and if meanwhile you think that there are some other metrics that are specific to your business and that you have found to be very relevant in driving valuation and attracting interest, please shoot them in the Q&A session and we'll go through them. Okay, so growth, it goes without saying, but growth has always to be paired with efficiency, which is at the bottom. There are too many companies that burn their cash by trying to get market presence, which is not that complex if you have the money. Then you fail miserably when everyone starts churning and you don't have a good business in recovering your CAC with client coaching. Okay? Sometimes because the product market fit is not there, or just because you run out of cash, or because your price was wrong, or whatever. Okay? Think that not all companies grow at the same pace. So you may have factors or obstacles that are natural, that are regulatory, that are language driven or localization driven. So all of these gives you different metrics and different reasons why you grow a lot or not. Okay? Companies may naturally grow at scale because everyone is in English and there's no regulatory. And some other companies you have to localize different countries and whatever. This is on and off. In net retention revenue or churn, this session is essentially about SaaS B2B. In SaaS B2B, as we all know, churn should be zero or even negative if you manage to do a lot of upselling. So we'll talk later about how the metrics stack up or how the metrics benchmark with market, let's say, yardsticks. But if your churn is or your retention is very, very different to the industry standards, you will have to explain it well, and probably it's going to raise some eyebrows at the beginning. Okay? So you have to preempt those questions. Remember, if you are small and you have to prioritize churn or growth because you don't have a lot of money, always start with churn, because that will show to the investor that you have product market fit, number one. And obviously, the other big reason is that managing churn is a lot cheaper than managing growth. Okay? And then finally, on acquisition efficiency, when companies are at a certain size and starting to scale, the key metric is CAC versus customer lifetime value. But at a smaller scale, and when you start and when you don't really have a customer lifetime value story because it's still fluctuating a lot, or when you are forcing your CAC a little bit because you're buying yourself your way into the market, CAC payback is also very important. Okay? And don't cheat. CAC has to be fully loaded. You have to put everything in there. You have to put all your costs into seminars, whatever you do, because when it is not fully loaded, it is detected quickly, and you have to have a standard and not a pro forma metric for that. And remember that payback is not done with revenue, it's done with margin, right? Because there are some fixed costs of running the business where even if you would stop selling and developing your product, you will still have those costs. So that's the reason why CAC payback has to be done with margin. This will show that you are a pro, not with revenue, which will show that maybe you are trying to trick your investor into showing a rosier picture of your company. So here, let us know if there are some other metrics, but typically those are the three metrics that impact valuation to 70 to 80%.
Absolutely, absolutely. Just any other that I can think of is any non-metrics, but factors that are related to human interaction, human to human interaction. At the end of the day, this is about people buying people. So again, I am looking for heroes to back, and those heroes are looking for somebody to to join forces with, to help them with. So they need to hire me, I need to hire them, and anything related to psychology really matters. That's difficult to measure inputs. Those inputs could be like part of the competition, bargaining power of each side. Again, we said if you have few term sheets, obviously the bargaining power is more on the founder side. If there's only one term sheet and the company's run out of money, the bargaining power obviously is on the investor side. There's also a bit of assertiveness. So basically it's like, hey, the founder comes in and says, this is the price. Are you in or are you out? And if the investor wants it, then it will just go through it, and the opposite. If the founder is not very assertive and it's a bit leader, and then maybe you can as a buyer, as an investor, you can achieve a lower valuation. This is our job at the end of the day, to get the best return for our investors. So the FOMO that we already discussed, and potentially some hot industries. What do you think about the hot industries, Xavier? Do you think that if you're in a you're obviously selling a product that it's sought after, that is new, in an industry that is getting hot for whatever reason, do you think that you can just get away without great metrics? What do you think?
It's a great question. Example of something that is happening right now with COVID and whatnot. There are a number of digital welfare companies. One of them was recently invested by Nauta, and there seems to be a huge hype in that market, right? And I'm sure these companies are looked more favorably by VCs at present, just because of the favorable market conditions and the tailwind that the industry has. I would guess the answer is yes.
Okay, perfect. Just finally, there's a rule of thumb, the rule of 40 in the SaaS world, in the publicly listed SaaS world. So basically, the companies need to be growing fast, but they also need to maintain a margin that is good enough. It's not all about growing if you are not being able to generate cash properly. Okay, so make sure that the sum of the revenue growth rate plus the free cash flow margin, which at the earlier stages of a company that is growing very rapidly may be negative, but this sum should be higher than 40%. Okay, this is a rule of 40 that is used to value SaaS businesses in the public markets and the Nasdaq. And this is something that you need to basically follow on, if not now, at least when you're getting closer to potential exit. Okay, that's the final point I wanted to say.
Excellent. Something else we wanted to discuss about today is how to SaaSify your company, right? So if you're raising funds in SaaS, you'd better use standard SaaS metrics, and you'd better sell, or you'd better manage a recurring revenue machine, and you'd better be in control of your subscriptions. Because if you cannot put together a comprehensive recurring revenue picture, this is not going to fly in a SaaS world. It will be considered a service business, or it will be considered a consulting business, or whatever, right? So these type of companies, so the ones that don't do it well, they tend to adopt pro forma metrics, they tend to manipulate the subscription metrics. I have seen that, and we've also at the temptation to manipulate the metrics sometimes. Don't do it because it gets spotted and it gets detrimental very quickly. Then you lose control of what the real metric is. So in a professional due diligence setting, you'd better have a billing stack well prepared and with many months of consistent data points, because eventually your subscriptions will affect your cash. If there is a disconnect between the subscription metrics and the financial metrics, right? Between billings and revenue and collections and cash flow, this is going to be evident and it's going to be an embarrassment. So let's talk about how you build your billing stack. It's not rocket science to start with. We think that you should be agnostic as to whether accounting is run externally or internally and which accounting system is being used, right? Provided accounting and the accounting firm and the accounting system are professionally done, to some extent, we are not going to recommend one or the other. The secret sauce of this comes in choosing your billing and your subscription metrics tools. In the past, a lot of SaaS businesses would just choose one from billing and one from subscription metrics, and then you create a billing stack by combining them, right? But now you have more services that have entered the market. First of all, end-to-end, so things that can manage the entire customer lifecycle from customer service, retention, and reporting, and also with a lot more reporting capabilities. So today you have billing systems like Stripe, which also run your subscription metrics fairly well. So the lines between, subscription and billing have blurred. Also think that this is not only about finance. So marketing will use them, operations will use them. For instance, they will need data on, for instance, billing frequency, and obviously customer success will use this data. So they will generate expansion revenue, and they will reduce. They want to reduce voluntary and involuntary churn, right? So when you design your billing stack here, you see some common household names that everyone will recognize in billing. I'm sure you know them. So Certify, Recurve, Zuora, however you name them, and in subscription metrics, Accessible, Chart Module, for Profitwell, etc., etc. So when you think, obviously there's Excel there. We'll talk about Excel before we leave this slide. But essentially, you should be asking yourself 3 questions when you design your billing stack, which is number 1, how big is your company, right? Number 2, how big are your clients? What type of businesses are you selling to? And then what's your approach to pricing? Is it very flexible? Do you have a lot of tiers? Is it changing a lot over time? So with this in mind, everything that is in this slide is well known. The takeaway is just use it well and don't abuse it. If you use Excel, use it as a last resource, but I think you do just want to make sure that you don't compromise on data quality and that you don't use an Excel as an excuse to tweak the data and create pro forma metrics. Okay? Be context sensitive in what you try to present here, right? The story that you present to investors needs to take into consideration what is your ultimate goal of the brand. So what are you fundraising for? What is the use of funds? The story is not going to be the same one if you're running a Series C or Series A or a Series B. So adapt your storytelling to context. Also, think about what is the key concept that you're selling, right? Are you selling a sales story where you will have to show that you can build a commercial organization and then acquire users efficiently and retain them? Or is it tech story where one of the drivers of valuation can potentially be the number of engineers that you hire and retain? Then, if it's a story about tech, then you will be forced to show a product roadmap, right? Which is sometimes not easy to predict 2 to 3 years ahead. So here, the message is be context sensitive when you present and you prepare your management accounts. And when we say context, context is dictated by the endpoint. So context is dictated by what you want to achieve, by what your unique selling proposition is, and from the maturity and size of the brand. Then it comes to the point where you have all the numbers.
just to emphasize the fact that at the end of the day, you're selling a story, okay? You have this great idea, this great story you want to sell, and you're basically trying to convince people to accompany, to go with you to the North Pole or the South Pole, right? Like, hey, anybody who wants to come with me to the South Pole? So you need to be very convincing. It's about selling stories and coherent story. So as you said, Xavier, it's at the beginning, maybe it's less important, numbers are less important. Then, it's the team, right? Then when the team has been working for a while and there's a product, then you should focus on the product. And later, obviously, when there's more, there are more numbers that there's more traction, there's more historical data, obviously the numbers become more important. And this is where you can actually apply more like the benchmarks that we're going to talk about.
Exactly. And actually, this is a segue into the next slide, which is about benchmark, right? So you come up with some numbers when you have your business plan ready, and then you don't know if whatever, a 30% margin is too high or too low, whatever the benchmark. So remember that the SaaS world produces a wealth of data science, and there's a lot of very geeky people in SaaS analyzing the data, producing studies, producing papers, running benchmarks. And sometimes they are super specific about an industry or a client case or whatever. Then what typically happens is that all of this science and all these numbers are used by the VCs, but tend to be lost in translation when we put together our investment thesis sell side, right? And sometimes it is embarrassing because your VC knows better what your numbers should be than you. This is not what we want, right? Typically, we don't want them to guess what our churn rate has to be or how pricing should be structured. And here, to catch up and to play game with your VC, you don't need to reinvent the wheel, but what you need to do is go to the sources of information that are available, usually for free. Some of them are in this page. They are not necessarily the only ones. And do your research and stress test your assumptions and stress test your models. And if at the end your result is contrarian, so you say, look, in this industry, typically churn should be 1%, but you know what? My churn is 5%. Okay, so at least you know that you are contrarian, and you will be hopefully able to explain why you are contrarian. Okay? And there's a specific case where we typically get a lot of questions, and this is really going to be a takeaway slide, Borja, if you agree, because we are running a little bit late with time. But typically we get a lot the question, okay, fine, all of this is very nice and we know everything, but top line forecasting is a problem. So people have a problem in forecasting revenue, especially when it is long term, and especially when the revenue model is going to change. So here we are giving a 6-step process that you can take home if you want, about how we recommend that revenue is projected. It's a storytelling exercise, but typically there are these 6 elements that we explain here. Right? Not going to run to the details, just take it home, and if there's anything you want to ask me or Borja, we are available. So for the benefit of time.
To remind you, we're recording the webinar, so we'll upload it, and we're going to try and put this document as well, on the net, so you guys can look it up later. But this is more of a takeaway slide for you guys to prepare your storytelling.
Interesting. So I think in essence, and before we move to Q&A, I just wanted to recap on the 4 main topics that drive the preparation for due diligence. We hope you found them interesting. There are a lot more that we didn't cover, so I'm sure we'll find and we'll get to Q&A immediately about those. So essentially, we discussed the importance of charting your investment landscape, how some metrics are more important than others in driving your valuation, how to approach management accounts when you're big, when you're small, make it context sensitive, and also how to do a business planning function that is flexible enough so that you and your VC can run different scenarios and motives. With this, Borja, I don't know if we can move to Q&A or you wanted to interject or there's something you
I think we can move to Q&A. We have a number of questions coming up.
Wonderful.
So the first one would be, so what documents should you include in a data room? What sort of documents should you prepare? Is there some sort of list that you can maybe not describe here exhaustively, but maybe we can put it for the for the takeaway? Xavier, what do you think are the minimum documentation they need to prepare?
Yes, this is do your research and Google that checklist. It will appear pretty soon. It's something that there are many models, and if you look at the ones that are prescribed at the top VCs, they will be there. So essentially, you have to do it in buckets, as you know, and the main topics that you have to cover without going into a lot of detail are all your corporate information, your main IT information about labor, about employees, which is critical here, and contracts, everything that has to do with key infrastructure, everything that has to do with obviously financials and tax statements and whatever, right? Anything that has to do with sales projections, funnel, etc., etc., etc. So my recommendation for this is do Google a checklist specific to SaaS, where, for instance, IP is going to be less relevant as if we were talking about biotech. So make your Google search specific, and you will come up with a checklist. It's a great reminder from the audience.
Excellent. Just to give you an idea, we'll talk about it also in the next episodes. But just Nauta, for example, we do a business due diligence before offering a term sheet, a letter of intent. But then when that term sheet is signed, we have a number of extra due diligences that the company has to get through. And number one is financial due diligence, tax due diligence, legal due diligence, technical due diligence. So you need to basically be ready, to face this all this questioning. Probably after you've signed the term sheet, but at some point you will. For the business, maybe you don't need that much documentation. What Xavier said and what's coming up on checklists is good enough. Another question from the audience is how to approach investors. What's the best way to get the contacts and to get the highest response? And if you don't mind, Xavier, I will take this one because it's basically how.
Better. Absolutely, you're the expert on that.
Thank you. Number one, led by the CEO or the co-founders. Okay, this is very important. We need to understand the team. This is who we're going to back. We're not going to back the product or the market. We're going to back the team. Okay, the founding team. And you guys need to sell. You need to be able to own the process. So you need external advisors if you need them to prepare, but the email to me, to an investor, should be from you guys, okay, not from a broker, let's say, okay, and then just finish the transaction and disappears. That's not good. Get a warm intro. That's something that Xavier said. It gets 6 times higher chances of getting funded, than sending a cold email. Sorry to say, but our emails are usually quite open. We have already mentioned them in several interviews or chats. We're ready to talk, and you can just drop find your way into our inbox directly. Do your research. That's something that we mentioned earlier. Know who you're pitching. Know your plan. Again, this is something that we've already mentioned. You need to have a clear strategy, a clear story, how much money you're raising, why, and then always follow up. So again, what's the best way of addressing? Just direct as a proper sell. This is a people's business, people negotiation. It's a people by people. So that would be my quick answer. And I don't know, Xavier, if you have any additional comments.
I think you covered it very well. So
okay.
Think about how you would like to be approached, right? If you were on the other side of the table.
Absolutely. Just one question about we're receiving questions about the price of the software tools. They're very expensive. are they worth it? Is it worth, paying for, one CRM, whatever, just Crunchbase, whatnot? Just what do you think?
I think they are expensive because they are good, but I think failing is even more expensive, right? And the fact that by using those tools, you are recognized as a standard player in SaaS is worthless, right? So I would definitely go for those tools. Then it is also true that you have different tools for different company sizes and different levels of maturity. So make sure you don't buy yourself a Rolls Royce to drive to the supermarket next door, right? But for instance, if you present a data room in Dropbox, this is going to be covered in the next session, right? Or your data room is sitting in something nicer, it could be OneHub or whatever, the impact and the impression is 10 times better. SaaS is run by standards. There's a lot of standardization in SaaS.
Excellent. Yeah, understand. Then one question from the audience as well. What do you think about, who should lead the process once they email, they're from the CEO, co-founders, has addressed an investor, but obviously the CEO is focused on execution. And is it good to leave it to the head of, VP of finance, needs to be led by the CEO? Could we have some external advisor, CFO as a service? What do you think, Xavier?
Yes, okay, I'm a bit biased here because I'm part of the answer as well. I think, like you said very well, investors want to talk to founders. The front end has to be founders, right? It cannot be part-time executives. But then the back end sometimes can be helped by either seasoned people who have raised funds before. So if possible, try to have them on your payroll so that even if they are part-time, they are part of your team, so that they have your email address. And obviously finance is a good, let's say, master of ceremonies, just because they are usually, or they should be, focused on processes. So they are typically good to manage a coherent process. So they have a role in there. But I think your comment earlier on, Borja, which is investors want to talk to founders. So if founders delegate, or if they have the impression they are not actively fundraising or just part-time or whatever, it's not going to be good.
Absolutely. So we want to talk to CEOs and founders, but it's better that the founders are prepared. So let's be honest. If you feel that you're not prepared, or you're not comfortable with this stance that we're having, this negotiation, just have people in the back, holding your back. So definitely get advice externally if necessary, internally if you can afford it. So basically you go and stick to us, having the best tools to be able to play the game. Then obviously it's up to the co-founders, the CEO particularly, to play the game itself. Good. I think we're running out of time. We're getting to the 1 hour. This has been really fun. I hope that you guys enjoyed it.
Interesting, yeah.
Very interesting. And again, these all the comments that we made, we put SaaS, but you could be expanded to software. Maybe a few metrics would be slightly different, depending on the business model that you're running. But at the end of the day, this is about due diligence, preparing for due diligence when you're doing any sort of fundraising. Okay, so it could be any startup really. It's basically all about the venture capital method. If you want to meet a VC and to get invested by VCs, this is how you should prepare to get the best results possible. And the next session, next chapter will happen on June the 9th. So this is in 4 weeks time, Wednesday, 6 p.m. CET as well. You guys, whoever's signed up to this webinar, hopefully already has registration for the next 2, but please expand the voice, our voice, share it with anybody. If you felt this was interesting and insightful, please just tell everyone there's plenty of space, and we would like to help the European ecosystem to really get the best for the founders. Xavier, do you have any other final comments you want to share?
Well, our emails are in the presentation as well, right, Borja? So people are free to reach out and send us emails. And if you hated the seminar, also tell us, because we're interested in that. We'll try to do better next time.
Perfect. Thank you very much, everyone, and hope to see you soon on June the 9th. Have a good day.
And you. Cheers. Bye-bye. Cheers, everyone.
Bye.